You, Mark. Great. Thank you, Mark. And thank you all for attending tonight. And also thank you to the Chicago Bar Association and Chicago and Evanston Public Library for hosting this event. We have a lot to cover tonight, so I'll try to be as efficient as I can. As Mark alluded to, if there's questions that pop up in the chat, I'll try my best to answer them while the presentation is moving. If I don't get around to them, I will stay for as long as you want to stay and answer anything after the presentation. So we will start first. I like to always counsel individuals when they're going into tax season to just take a moment, take a couple moments to brainstorm and gather information. And first, I think it's super helpful to come from the tax preparer perspective often is that just take a couple minutes to maybe draft a memo for yourself and or your CPA and tax preparer and try to formulate your thoughts on, what could have changed during 2025 compared to 2024. Because a lot of these, a lot of your changes, you're going to be looking back in retrospective of the year. I don't know how many of you feel, but I feel like it's been a very long year for all of us. So it's easy to forget things. Think about things such as, did you switch jobs? Because therefore you might be receiving two W-2s this year instead of one. Did you sell your home? Did you refinance your mortgage or obtain a new mortgage with a new bank? Therefore, you might be receiving some new 1098 mortgage interest statements from some new banks. Did you open up a new bank or investment account? Again, along the same lines, you might be receiving new 1099s that you've not received in prior years. Or did you start a new business? And for that, did you properly track things, or are those things that you have to go back to kind of recollect? And one point on starting a new business is that oftentimes what we'll see is people will put things on the personal credit card or personal debit card before they open the business. That is okay. That's common practice before a business credit card is started. So if you did that this year, go back, collect those expenses, and tell your CPA or an accountant about them. You could be able to take deductions and kind of work some reimbursements back and forth. So if that happened to you during 2025, that is okay. But make sure to go back and really try to collect all those expenses and all those revenues so you can properly report everything when you go and file your taxes. So again, just some, I think, prevailing material information that I always try to tell people because, a lot of these things are relatively, well, one of these things is relatively new, the digital assets, but the sale of the home and the new child dependent are two things that I think a lot of us encounter throughout the years. And so I'll start with the digital assets. So obviously, many of you probably heard, a new prevailing investment vehicle is things such as Bitcoin or other digital assets. And on the Form 1040, so on your page one, right on page one of the form, about 5, 6 lines down, is a question that all taxpayers have to mark. Anyone who files 1040, in the entire world has to mark this checkbox. So I always point it out. It applies to everybody. And you have to state on there, yes or no, whether or not you engage in any taxable transactions involving Bitcoin or any other digital assets during the year. So if you open up, a Coinbase account, or if you're someone who's, really deep into crypto assets and you have a cold storage, whatever it is, this is a very important question. It pertains to anyone filing a 1040. So I always point out to people to make sure you correctly mark that checkbox, yes or no. Sale of a home. Oftentimes, people will be selling their home. And so I just always like to highlight that any homeowner of any age can exclude the gain of their principal residence, provided that three tests are met. You own the home for 2 out of 5 years preceding the sale. You used the home for 2 or 5 years preceding the sale, and you've not taken advantage of excluding the gain in the 2 years prior to the sale. So if you sold your principal residence, a year ago, and now you're selling it again, unfortunately, you can't take advantage of the gain exclusion on the subsequent sale since it's within that 2 years preceding the subsequent sale. So the maximum exclusion of that sale is $250,000 for single filers. and $500,000 for married filing jointly. And one thing I would like to add to that is oftentimes people will ask, do I have to pay tax on selling my home? Is I will remind them that your purchase price when you purchase that home, even if it was 30, 40 years ago, that's what's referred to as your basis, okay? And so if you bought your home in 1992 for $100,000 and now it's worth $300,000, if you sell for $300,000, you'll think, oh geez, I'm going to be subject to $200,000 of gain. Well, obviously here your exclusion would eat that up, but before you even get to the exclusion part, your basis, that $100,000 you purchased that home, you get to add to that basis. So any improvements you made on the home. So that could be any type of capital improvements, any type of home interior or exterior structural changes. You got a new roof, you got a new HVAC system, anything like that. That adds to your basis. So if you bought that home for $100,000, last year you put in a $50,000 new HVAC system. Your new basis is $150,000. So now when you sell for $300,000, you're only looking at potential gain of $150,000 instead of $200,000. But that wouldn't matter anyways because you'd be able to exclude the gain. But I just want to point to that example because a lot of people miss that in the calculation they have when they get worried that they might owe any tax on the sale of their home. New child independence. This stat, of all the stats in this country, bothers me the most. There's approximately, and I just updated this, but it's still prevailing current day, 3 to 6 million children are unclaimed on tax returns. And, that could happen for a variety of reasons. Either there's either a unique family situation with a child split in homes, and maybe it's not documented legally as it could. But oftentimes people could forget, right? I mean, if you have a child in December, November of 2025, and you're going to your tax preparer in April 2026, those first few months could be kind of blurry for new parents. So sometimes you can forget, like, oh my gosh, my child was born in December and I get to claim them on my taxes. And it doesn't matter if that child was born on December 31st at 11:59 p.m. That child you can claim as a new child on your tax return. So I just always like to point that out because again, that to me is still a very high number of children who are unclaimed on tax returns, and there's tons of benefits you get: child tax credit, earned income tax credit, etc. when you have a child or dependent. And I add the dependent part too because people can often find themselves in circumstances where either their parent, their grandparent, a cousin, aunt, uncle who moves in with them, and so and you're taking care of them. So if that happened to you and they lived with you all the year, you can then take, claim that as a dependent on your tax return. So I always like to point that out because I think these are two areas that often, surprisingly, a lot of people couldn't miss. And there's a lot of tax benefits that you can take advantage of when you have a new child or dependent on your tax return. Let me just take a quick peek at the Q&A. Okay, the case about the land trust, I'm gonna take after because that's a little bit complex. So I will answer that at the end of. Okay, so moving on. And I want to point to you guys also some useful online resources. There's been a big shift especially at the federal level, as many of you are probably aware of. They're trying to update the IRS technical capabilities. And so I want to point you guys first towards a useful online resource of the IRS. It's called Online Accounts for Individuals. So you can go right to the IRS website, create an account for yourself. And I think it's a great way to, and it's mobile friendly. You can do it on your computer. I push all my clients to do it. And it allows you to view all your key tax information. If you ever have to amend your return or you owe a refund, you can track the status of that right on the online portal. If the IRS is sending in notices to you, you can view any digital notices sent to you. And if you do have to make a payment to the IRS, whether it's an estimated tax payment or tax liability due, at the end of the year, I want to point out to everyone that as of September 2025, the IRS has begun phasing out tax refund checks for individual taxpayers. So if the IRS owes you money, they will no longer be sending tax refund checks in the mail. So therefore, you have to choose direct deposit on your tax return. So please, please, please verify, double check, triple check that all your bank account information is correct when either you have your CPA or some other tax preparer prepare your tax return. Because when you if you miss even one digit, it's kind of a headache to get the IRS to fix that. So I just point to everyone, just double check, triple check. And if you're used to receiving tax refund checks as of September 2025, the IRS will no longer be doing that. And then on the flip side, if you were used to paying the IRS tax liability or estimated tax payments, the old system that was called the Electronic Federal Tax Payment System is now being phased out. So they're not accepting any new enrollees as of October 17, 2025. So that's more of a reason to create an online account with them, and you can make any payments directly on to them online, and you don't have to send any more checks or use the FTPS system because it essentially won't be available for any new enrollees. Also for Illinois, I would also recommend creating an online account on the Illinois website. It's also very, very user-friendly. Very user-friendly. It allows you to view any digital notices, make review payments, track status of refund, look up any estimated or extension payments that you made. So you can see here in this key here, it's a real useful site, mobile friendly. So would also recommend everyone setting up an account here too. Because it just makes everything more efficient. And if you have troubles, a lot of times you can solve them on the online portal now, and you don't have to kind of write. I'm used to still up to recently still not handwriting, but writing notice responses to the IRS and mailing them and faxing them, whatever it is. And the online portals have improved significantly over the last year or so, which allows you to correspond directly with the agencies if you have any issues. One more piece I want to point out to them, which again, I'm sure a lot of you are aware, the online property tax portal for Cook County. This is very useful to get your property tax information for when you file your tax return. And always remember too, I see this mistake a lot, property taxes work in arrears. So the property taxes that you will pay in 2025 are actually for 2024, right? And so when you go to the Cook County website, so how the tax deduction works is don't take the 2024 amount, right? Take your 2025 amount, even though even though it's for tax year 2024 and it's billed in 2025, a lot of people get confused. It is the cash amount that you paid in 2025. So hypothetically, when this individual pays their second payment for their property taxes, the second installment will appear here. Make sure you take that figure. Don't take your any of your prior fingers so you get so you get your full deduction. And one little cliff note, I don't want to get too far off track, but I know that the property tax bills just came out, I think a day or two ago. I know I haven't met or heard from anyone who's happy about their bills. So I just wanted to add in a little footnote. There are payment plans at the Cook County level. So if you can't make your payment by December 15th, I included this. This is on the Cook County Treasurer's website. There's a payment plan calculator that allows you to pay your property taxes in installments. So I just kind of want to add that note to anyone who was not aware of that. So moving on to federal legislation, the most, really the only, but the biggest federal bill is the One Big Beautiful Bill. And it was signed into law on July 4th, 2025. But what was important about it is that all the tax provisions I'll speak about in the next several slides are all retroactive to January 1st, 2025. So although it was signed into law in July, everything I'm going to discuss covers the entire tax year of 2025. So generally speaking, it extended many of the tax cuts from the 2017 Tax Cuts and Jobs Act. So, so if you're used to filing your taxes under some, different rules that you're used to, a lot of those have or will continue on. They're extended. But there are several new temporary deductions that I want to point you all to, and that is it's kind of a broad overview. That's the bonus deduction for seniors, the no tax on tips deduction, the no tax on overtime deduction, and the car loan interest deduction. So for 2025, some kind of key tax metrics. You'll see here are the tax rates. So we still under the one big beautiful bill. It's still lowest rate's 10%, highest rate is 37%. But you can see how the income levels kind of phase in at different rates for different filing status. So, singles, you pay 10% of tax on income from $0 to $11,925, and so on and so forth. The standard deduction, so for singles and married filing separately, for 2025, it's actually $15,750. That's an increase of a little over $1,100 from 2024. And you'll see also for married filing jointly and head of household, the standard deduction for those filing status increase as well. Illinois' personal exemption, which is another way of saying their version of the standard deduction, remained at $2,850, plus you get additional $1,000 if you're age 65 or older or you're legally blind. Illinois tax rate is still remaining at 4.95% flat tax on all levels of net income. And at the federal level, you do get another additional standard deduction for those 65 or older of $2,000. So kind of here's a broad overview. Again, tax rates did not change. The levels of income were adjusted for inflation. So, there is an uptick in what levels of income you have to make to be subject to the different tax rates. But I would say the primary change is really the standard deduction. Standard deductions, went up, pretty good amount. But again, a lot of these are inflation adjusted, so that was expected. That was an expected change for many of us. So the bonus senior tax deduction. The purpose of this was to shield more of the seniors' retirement income, particularly Social Security benefits, from federal income tax. This deduction was structured to nearly cover the maximum taxable portion to the average Social Security benefit. So Social Security benefits are only taxable up to 85%. And so this deduction allows, for those who kind of reach that threshold, this is a really powerful deduction. I mean, this is brand new. I'm not aware of any time in tax history that this type of provision has been introduced. So I want to point you guys to this, and again, make sure if CPA, taxpayer, whoever it is, if you qualify for this, make sure you're getting this, because it's $6,000 for each taxpayer, $12,000 for married filing jointly. So it is subject to some income thresholds. So for single filers and head of households, $75,000 or less, and joint filers or surviving spouses, $150,000 or less. And you'll see a lot of these thresholds refer to modified adjusted gross income, MAGI. So I just want to point out the MAGI is essentially your gross income less any line deductions plus some certain add backs. So things like IRA contributions, non-taxable Social Security payments, those are added back to calculate this MAGI. Any tax software that any taxpayer is using will do this automatically. So this is nothing you're going to have to add up on yourself. So I just want to point that out, because there are some areas of this presentation where I do refer to that. But again, you will not have to worry about that. Whoever's preparing your return or whatever tax software you're using should do this for you. So for $6,000 for each taxpayer, $12,000 for married filing jointly. And what is great about this deduction is it allows, all the deductions I'm going to talk about in the next 3 or 4 slides here, allows you to stack. So Okay, if you're taking again, if you're taking that standard deduction, say if you're a single filer and you're over the age of 65 and you qualify for this bonus senior deduction, right? So you're going to get standard deduction of $15,750, just right off your top of your income. That's going to drive your taxable income down. Then on top of that, you get to stack your bonus senior to tax deduction. So again, for a single filer, you get an additional $6,000. You're looking at $21,000 of deductions off your income to calculate your taxable income. So so this is very powerful. There's no limitations to stacking these deductions. And as you'll see throughout these slides, if all six or all the next 4 or 5 slides pertain to you, I've seen nothing in the tax law as of date that tells you that you cannot continuously stack all of them on your tax return. So we will then move on to the no tax on tips, which probably many of you've heard about. But as of today, the the temporary regs, and I'll show you the next slide. The workers that are eligible for this is very broad. So if you're in the service industry or if you do receive tips at your job, make sure you pay attention to this. So the purpose was essentially to provide direct and tangible tax relief for working class Americans, particularly those in the service and hospitality industries. So employees and self-employed individuals may deduct qualified tips received in occupations listed by the IRS as customarily and regularly receiving tips. But here's the kicker. The tips must be reported on a Form W-2, Form 1099, or other specified statement furnished to the individual. So if you work for a restaurant, they should be doing this for you. Okay, so this should be kind of normal operating procedure, but double check with the employer, make sure they're doing this, because if they're not, you're going to have a hard time excluding these wages from your tax returns. The IRS, they're going to receive a copy of your W-2 on the back end. Then when you go file your taxes, their system's going to link that up. So double check with your employer if you work for a restaurant or hospitality or any other listed occupation. I'll show you in the next slide. Make sure your employer is doing this for you. And again, as I said in the last slide, all these go back to January 1st, 2025. So if you've been receiving tips in January, February, March, April, whatever, speak to your employer or speak to your manager, whoever it is, make sure they're tracking this stuff for you properly. So you're able to deduct this to be non-taxable. Because you can see the maximum annual deduction is $25,000. I mean, that's a significant amount of money if everything's tracked properly and you qualify. And the qualified tips definition there, voluntary cash or charge tips received from customers or through tip sharing. For any self-employed individuals, so I'm kind of thinking, I believe how DoorDash or Uber Eats kind of operates with the independent contractors. The tips that you receive, you are limited. This deduction is $25,000 deduction, or the maximum deduction can't exceed your individual net income. And there is some phase outs there again at $150,000, $300,000 for married filing jointly. So still pretty significant. The only kind of kicker, if you are married, you must file a married filing joint return to claim this deduction, and you must have a valid Social Security number to claim this deduction as well. So I'll show you guys as of today, and I double checked today to make sure they did not change the proposed regulations. The proposed regs have all of these occupations as qualified to obtain this deduction. So as you can see here, the list is quite expansive. I think more expansive than I think a lot of us anticipated. To be honest, I think there was some kind of commentary that they thought that this was probably going to be limited to kind of restaurants or hospitality. But, I was looking at, your roadside assistant worker, get a flat tire on the highway and, you tip him or her, $20, $50 for helping you out. They get to exclude that from taxable income. So it's quite broad, this list here. And as I said, as of date, they've not, trimmed this list down or anything like that. So I think this is good to go as of right now. We'll see, over the developing months here, but I'll be pretty surprised if they reversed any of this guidance, but I just want to point that out. There is this is under proposed regulations. Oftentimes those kind of sit, and if any of these get trimmed or reversed, I'm sure you guys will become aware at some point. So I just want to share this list as of right now. So if you fall under this list, again, make sure your employer is tracking these things properly so you can get this deduction. The no tax on overtime. The purpose of this was to reward workers, particularly those in blue collar and hourly wage jobs, for their extra effort by letting them keep more of their pay they earn for working beyond the standard 40-hour work week. So the maximum annual deduction is $12,500, $25,000 for marriage filing jointly. So I think the kind of kicker to this that is in the fine print here is that so you may only deduct the pay that exceeds your regular rate of pay. So not the full overtime wage. So I think, for example, here, if you earn time and a half, okay, so if your regular pay is 30 hours per hour and you work overtime and you earn time and a half, and now your rate's $45, only that $15 is essentially tax-free, or you get to deduct it. And the other kind of kicker in the fine print here is that your overtime pay must be required by the Fair Labor Standards Act. So, I'm not an employment lawyer, but how I understand this law to be is that under the Fair Labor Standards Act, that's the floor. That's the kind of minimum that workers must be provided. And the overtime must not be covered under a collective bargaining agreement. So I'm thinking here in Chicago and Illinois, a very heavy union state and city. I don't believe that their collective bargaining agreement overtime provisions actually qualify for this deduction. And I think it's only going to fall under what is required under the Fair Labor Standard Act. So how I think that this is probably going to this will play out, and again, I'm not an employment lawyer, so I don't want to get too far out of my bridges here, is that, for instance, if you're a union truck driver, and say on Monday and Tuesday you work your normal 8-hour day, and then Wednesday, Thursday, Friday you get rained out, and you come to work on Saturday, under most of the union trucking contracts, when you come on Saturday, you're eligible for time and a half or overtime pay. Since that Saturday is covered under your collective bargaining agreement, that pay that you earn on Saturday, I don't think, unfortunately, is going to allow you to deduct that and be eligible for the no tax on overtime. So I think that's the kicker. I'm kind of interested to hear if any employment lawyers out there or there's any more guidance on that. But from our understanding, that is how this legislation is written, and that is the intent. So again, just a disclaimer: I'm not an employment lawyer, but this is how I'm interpreting law. So I think that if your overtime pay is covered by a collective bargaining agreement, it's unfortunately not going to be eligible to be deducted here. But if not, and it falls under the Fair Labor Standards Act, which I think is pretty much anyone outside a collective bargaining agreement, if you work overtime, you're getting overtime pay. You get to deduct that on your taxes, and that gets to be tax-free. The car loan interest deduction. The purpose of this was to stimulate the purchase of new U.S. assembled vehicles and offset financial burden of financing a new car. So you can deduct an annual deduction of $10,000, and that phases out with modified adjusted gross incomes over 100,000 or 200,000 for joint filers. So here are the rules. The interest must be paid on a loan that's originated after December 31st, 2024. It must be used to purchase a new vehicle. It does not qualify. This deduction is not qualified if the vehicle is used. The vehicle must be for personal use, not for any business or commercial use, and it must be secured by a lien on the vehicle. So essentially, anytime you do take out a loan from the bank, they're going to throw a lien on the vehicle anyway. So those are the criteria. Also, lease payments do not qualify. So again, the interest we pay on the loan, you get to deduct up to $10,000 of car loan interest expense on your tax return. And again, I'm not aware of any history of this, so this is very brand new. And I think if you're in the market for a car, you're going to get a real nice benefit for this. But again, the loan must have originated after December 31st, 2024. And I did look at some of the gray area of this, that if you went car shopping on let's say on December 31st, 2024, but the loan did not close until January 1st or January 2nd, 2025, that's okay. So I believe that that language originated after December 31st, 2024 is not interpreted as, the day you go to the car shop and pick out your car. It's kind of when all the loan documents and everything's closed is the legal date of when this kicks off. And then just that last little note, qualified vehicle is pretty expansive. A car, minivan, van, SUV, pickup truck, motorcycle. And that last piece, it must have undergone final assembly in the United States. If you take the VIN number on that car and you just go online, you look up the VIN number, it will tell you whether it qualifies for this, whether it's undergone final assembly in the United States. So if you're at the car dealership and you're wondering if your car qualifies for this deduction, take the VIN and look it up online, and it'll tell you if you qualify for this last piece there as well. So again, in before we move on, again, we talked about the bonus senior tax deduction, the no tax on tips, the no tax on overtime, and the car loan interest deduction. If somehow you qualify for all four of those, again, I see nothing in the law as of today that shows you that you are limited to not take all four. So, I mean, I think that'd be pretty astonishing feat if you did qualify for all four. But if you do, you get to take advantage of all of this, and obviously subject to some income limitations. So you can, again, kind of what I said a few slides ago, you can stack these deductions on top of each other, and they're not limited, and they don't they're not limited by correlating with each other like some other credits. Tax credits have worked in the past. So this is all kind of brand new. I think it's all really great stuff if you qualify for it. The child tax credit, this changed as well. Essentially, it was updated to prevent it from reverting back to pre-2017 levels of $1,000, and they added $200 to the tax credit. So it's now $2,200, up from $2,000. And the partial refundability of $1,700 is made permanent through 2029. And so that's the maximum amount a family can receive back as a refund, even if they owe no tax. So if you claim the child tax credit and you have zero tax liability, you actually can get that 17 at least up to $1,700 as a tax refund, even though you don't owe any liability. And the phase outs jumped, I think, pretty high as well. $400,000 for married filing jointly, $200,000 for other filers. And whether, again, not to get too in the weeds, but if you're curious about whether your child qualifies for child tax credit, it is a 6-part test. It's the age test. They have to be under the age of 17. Residency test, have to live with you for more than half the year. You have to provide more than half the support for them. They have to be a U.S. citizen, and the child cannot file their own tax return, which is a pretty rare, but it's a 6-part test. Run it by your CPA or tax preparer if you're unsure. But for most people claim the child tax credit, they satisfy that test pretty easily. Another big change, and this is good news for us citizens of Illinois, New Jersey, New York, California, kind of high tax state, is the state and local tax deduction, the SALT deduction. It's raised from $10,000 all the way up to $40,000. So over the last several years, we have all been limited to, if we talk back to our property tax discussion, not to bring up a sore topic here, but many of us on this call are probably paying or close to paying more than $10,000 of property taxes at this point. Unfortunately, on the last law, the last few years, we were capped at deducting $10,000 of our property taxes on our tax return under the SALT, the state and local tax deduction. So if your property taxes were $12,000, $15,000, you might not notice, but you were only able to deduct $10,000 of that. Now it's $40,000. So it's a big sigh of relief for for many people who are exceeding that $10,000 threshold. Because now they can kind of get the full deduction that they deserve. And that also includes any state tax income withholding that you pay. So if you're W-2 on your and you got withholding the state income tax, that is now above the cap as well. So you're paying state and local tax, or state and local income tax, state and local property taxes, and it exceeds $10,000, your deduction is now capped at $40,000. So you got now $30,000 of breathing room to work a deduction that over the last several years you've not been able to do with the SALT cap at $10,000. So that was a big point of contention of the bill. Actually, almost held up the bill at the final hour, but the legislators finally gave in and gave some of these some of the high tax states such as ours in Illinois some relief here, getting the SALT deduction back up to now $40,000. Now we've been speaking a lot about what was added to the bill. And I think I have to point out what was taken out of the bill under old law. So the $7,000 credit for new electric or fuel cell vehicles has been completely eliminated. So if you bought a car after September 30th, 2025, unfortunately, you're not going to qualify for that tax credit anymore. But if you bought a car before that, I believe a lot of that paperwork is done at the dealership. I know that the Tesla dealership does that all for you. And I'm sure all the other dealerships do as well. Um, so you probably already had this handled, but if for some reason you did buy an electric car before September 30th and your car dealership didn't tell you anything about this tax credit, and I'm now here telling you that this is no longer here anymore, you're not totally out of luck. You can go back and get that $7,000 credit as long as you purchased it before September 30th, 2025. The energy efficient home improvement credit that's been around for a few years now. Unfortunately, you won't be able to claim that for any property placed into service at the December 31st, 2025. So I just kind of want to point out some of the items that are eligible for improvement. I remember we spoke about this, I think, 2 or 3 years ago, last time we all met, was that any type of high efficiency systems such as heat pumps, water heaters, biomass stove boilers, windows, doors, etc. Anything that qualify for the energy efficient home kind of sticker. Unfortunately, you won't be able to get a credit for those purchases beginning after December 31st, 2025. But if you already brought one, or you got one on the way to be completed for the end of the year, or if you got one that you scheduled to be completed after the year, maybe after the holidays, call those people back up, see if they can see if they can come install this for you in before the year end, because this credit will expire. And same thing with the residential clean energy credit. Those two credits worked very closely with each other. Again, it won't be allowed for any expenditures made after December 31st, 2025. So that was for things such as solar panels, battery storage, etc. So if you're planning on doing any of those, and you want to claim the credit, try your best to get those done before the end of the year, because once the end of the year is over, unfortunately, these expire. And I will end kind of with just some health and retirement deductions. Nothing has changed here under the One Big Beautiful Bill, but I just always like to point it out. So traditional IRA deductions, again, 7,000 for 49 and younger, 8,000 for 50 and older. Health savings account deductions, you see the different amounts there based on your age or based on what coverage you got. Self-employed health insurance deductions. Um, any of your mental or your medical or dental expenses that you incurred in 2025, if you think that they exceeded your 7.5% of your AGI, so your AGIs, your adjusted gross income is $100,000, you'd have to incur medical and dental expenses exceeding $7,500 to start deducting those on your tax return. Um, I always tell people, just collect as much as you can, get all the documents, and then when you go to file your tax return, have the taxpayer, your CPA add it up, see if you can get a deduction for it. It's better to have it than not have it, and you don't want to miss out on any deductions. Even if you barely make it, even if it's $1, I think it's worth it putting down. Um, again, they're the levels for long-term care insurance premiums. And I included some asterisks because people get tripped up oftentimes about this as well. So the ones with the single asterisk, the IRA deductions, health savings account deductions, the SEP insurance deductions, those all must be paid by December 31st. However, medical and dental and long-term care insurance premiums can be paid by April 15th of the following year to get those on your tax returns. Um, and some miscellaneous provisions that I think were important to include 1099K reporting. Last year, under prior law, if you received over $600 of income through I believe it had to be dedicated as a business account on either your PayPal or Venmo, yeah, for your businesses, you received what was a 1099K. And I mean, $600 is a pretty low threshold, especially, if you're doing business and you're getting paid, um, anything above that, you likely received the 1099K. What the One Big Beautiful Bill did was actually eliminated that $600 threshold and put it to the gross payments now have to exceed $20,000, and the number of transactions have to exceed 200. So if your business has to exceed 200 transactions on your PayPal or Venmo or whatever it is account, and your gross payments have to exceed $20,000 for you to receive this 1099K. So if you don't receive the 1099K, it's likely because you fall under this threshold, and you no longer having to report that, or really have to receive that data, or report that data to the IRS. So I know that's big relief because $600 is kind of a low threshold, and it applied to a vast majority of people doing business on those apps. So it kind of lowers the administrative burden of conducting a business. And one other question I want to point out, or one other change I want to point out, the IRS Direct Free File program that was started, I think, in 2023, and the pilot program I think began in 2024 is the first year, or maybe it began in 2023 and it happened again in 2024. Unfortunately, they terminated that program. So now they're going to, at some point, do a public-private partnership. I don't know if that's going to be with programs like Intuit or some other software to try to restart that program in some other way. So there's no word on that as of date. But I do want to point you guys to freetaxusa.com is a very useful website to file your taxes for free. I think they charge very minimal for a state tax return as well. As things last year is between 20, $30, real cheap. So if you're looking for a place to file your taxes for free and you're eligible to do it, I'd point you to freetaxusa.com. The city of Chicago has their own free tax preparation services as well. That's at taxprepchicago.org. And then a organization that I'm actually involved with, and I served on the board for a few years. It's a phenomenal not-for-profit here in Chicago, and they do a lot in Chicago and the surrounding suburbs, is Ladder Up. And they have free tax preparation sites for eligible taxpayers to prepare your taxes for free. So although the free IRS Direct Free File program has been terminated, there's still a lot of options to get your taxes prepared for free if you qualify, and things such as Free Tax USA, I think, are very financially feasible if you're looking for cheaper options as well. So I just want to point those out. And so that concludes all of our changes for the 2025 tax filing season. So I will go back to some questions. I think I got a good bunch here. Let me start with, I'm still going to pass over the beneficiary land trust. That's a complicated question. So I'll come back to it at the end if you want to stay on, whoever that was. So what happens to people that do not have a bank account? Direct deposit to where? That's a great question. I would say try to find a very generous friend or family member who will let you use theirs and trust that they'll send you the money. I would, encourage you to open up a bank account. That would be a big step, that could help. But that's a great question. If you don't have one as of date, again, I would try to encourage you to go open one up. If there's reasons why you can't open one up, I would just try to find I guess a trusted friend or family member who will take that money for you um, on your behalf. So, like I said, unfortunately, if you are owed a refund, the IRS is not going to send you a paper refund check, under current day. Now, the IRS is notorious for doing things like this, and then when the tax season gets going, they realize how many people are relying on a tax refund check. They could reverse that course, but I would go into tax season under the understanding of, as of today, they're no longer going to be sending out tax refund checks, and that you should, figure out a way to get direct deposit if you're owed a refund. Okay, do you know that? Okay, so you own your home 48 years. Yep, replace windows, of course. So again, that's a very common issue, and I would point you to, again, likely you're gonna fall under exclusion of 250,000 or 500,000 if you're married filing jointly. As far as receipts, that's something that try your best to maintain those moving forward. And if it comes down to it where you did sell your home and you are subject to tax, which I think, again, it's very rare. It's a lot more rare than you think. Talk to your CPA, talk to your tax preparer. I think that some CPAs, tax preparers, will take the position that they'll take your word for it, and they'll calculate off your basis, and that if unfortunately there ever is an audit on it, which again I will tell you from my professional point of view is probably going to be rare. That's going to be something they'll have to negotiate with the IRS agent. And of course, you're not going to have improvements from 40 plus years ago. That's going to be hard to track those things down. But moving forward, keep track of it, because I think it's important to keep track of. But again, if you somehow fall above that gain exclusion of 250,000 or 500,000 for married filing jointly, not all hope is lost. And please speak to your CPA, tax preparer, and try to figure out a comfortable position for all parties to take on that matter. If it's does the overtime pay, if it's paid as a bonus, fall under the deduction? I would say yes, yes, and I think that is something that you would want to speak to your employer about, because on the W-2, when they file your W-2 with the IRS, that's something they're going to have to itemize for you. So whether you receive that overtime pay, throughout all your paychecks, you receive it once at the end of the year. I didn't see anything that limited that. But again, I really want to emphasize to everyone, go back to your employers your payroll process, whoever's working a company, make sure they're tracking this separately. And if they're not, you have to take a position that they have to start doing that, because whatever they report to the IRS, whether you get paid through a 1099 or W-2, that's what the IRS is going to take. So if what they issue when they file your W-2 at the IRS, and then you take a different position in your tax term, you're going to open yourself up to an audit risk. So that's why I'm really emphasizing the point, talk to your employers. But I don't see any issue if it's paid as a bonus that's going to limit you to not claim the deduction. Retirees' income is not taxed by Illinois, so non-taxable. For solar panels, do they have to be installed in 2025, or just the project had to be approved? Great question. I believe for that credit, again, that credit came about 2 or 3 years ago, so I'm trying to think. I'd have to refresh my memory. I would say it's when the expenditure took place, and not when the installment actually occurred. But I think that was for the latter credit. So I want to say you could probably be eligible if the expenditure took place. But I'm going to preface that I'm not 100% certain about the if it has to be installed by the end of the year first. I did not see that when I was reviewing the updated tax legislation, so I'd really have to go back and research. But definitely if the expenditure took place, but there might be a little kicker there with the installment. So I would have to look at more into that. Um, mentioned that the IRA HSA deduction had to be complete within 2025. When I filed to contribute during filing 2026, is that no longer the case? No, they should occur in 2025. Um, so I would try and make those deductions by the end of the year. How many overtime hours qualify the deduction? So it's actually the amount of money. So it's $6,000. It's $6,000 and $12,000. Um, and so it's you can have unlimited overtime hours. There's no cap on the hours. It's all about the money. So 6,000, 12,000 for that deduction. Um, how about Zelle transactions? I don't believe Zelle, I think Zelle was sending 1099Ks last year. So but now if it exceeds that $20,000 amount at 200 transactions, then you will receive 1099K. But if you're under that threshold, and again, it's a business account too. That's the preface too. I know some people were confused with that as well. From our understanding, they only send the 1099Ks if it's a business account um, on their platform. Um, where can I learn more about the salt tax deductions for a property? Um, I'm not sure. I'm not sure what you mean, but I'm assuming like if your real estate taxes, you want to get more information on that, that would obviously be on the Cook County portal. Um, the your Illinois withholding will be reported on your W-2, so those are two source documents. If you're wondering maybe about what other deductions qualify under the SALT tax deduction, those are listed online, but they're pretty rare to because Illinois doesn't have a lot of I think the proper terms like ad valorem taxes like other states do. So really for Illinois, it's going to be your property taxes and your state income taxes that are going to qualify under the SALT deduction. And I do want to go back to the uh, the question about the IRA deduction. I think I might have mistyped that on my presentation. I apologize for that. You are correct. You can make those. You can make those by the time you file your tax return April 15th. I'm sorry. Those should have two asterisks next to them. So I apologize for any confusion to whoever asked that question. Um, do those claiming child tax credits have a delay time to receive tax return? To receive the tax return, do you mean file? If you mean filing an extension, you can file an extension. And if you do that, make sure you tell your taxpayer you want to extend. You won't file in April, you'll file in October in 6 months. But if you do owe tax, if you do have a tax liability, you will have to pay in April. But if you have a situation where you need to figure out, whether your child, you're going to be able to claim your child for your child tax credit, that's fine, and I encourage you to do that. I'm not making any assumptions, but when clients have that, sometimes instant to a divorce, it's very normal to extend that time of filing to sort out who's going to claim the child on your tax credit. So that's totally okay to do. It happens all the time, but just make sure you communicate that to your taxpayer CPA. When you go file your taxes, and you can extend your tax return to figure that out if you need more time to do that. Um,
I think these next two are about the retirees. That question was
for sure. Yeah, so Social Security is non-taxable in Illinois. So that's um
retiree income, yeah.
Yeah. So interest income. So yeah. So the interest income would be taxable even though you're a retiree. So it's just Social Security. Are there any deductions for time spent as a power of attorney for my 9-year-old brother? Um, Unfortunately not. No, you're not going to be able to take any deductions for that. And that's more kind of an estate or a probate issue. But what I'll say to you is Sandra, is document how much time you spent on that. And if there's ever a probate or estate issue, you're going to want to document how much time you've dedicated to helping out your brother. So I would just encourage that just for record keeping purposes. But that's outside the purview of this income tax discussion. But there's no deductions for that time spent for the power of attorney. Is Illinois tax retirees interest income? Yeah. So I mean, if you're receiving a 1099 interest from a bank, um, or a brokerage account, even if you're a retiree, that will be taxable, if that's what you mean. All right, so here's the land trust question. Okay, so in the case of a death of a homeowner, the property rolls over to the beneficiary via land trust, who writes off the second tax payment this year. Does it follow the original owner of the beneficiary who actually paid? I would say the beneficiary, as long as legal title transferred at the time that the payment was made. So, let's say payment year. So if you or whoever the beneficiary was as of October 6th, or whenever that was finalized, and you paid and now the property is legally you, and you paid that second payment, you should be able to get that deduction.
Cool. Well, thank you
Good, Mark.
so much for this, Robert. To anyone left, I will be sending out a link to the YouTube video of this presentation once it's live. That usually takes a couple of days. So I'm just going to send out an email to everyone who was registered. And then you can review this at your leisure. But yeah, thank you. This was super, super helpful. Even for me, especially the stuff about the new tax deductions. So I really appreciate it. And please keep an eye out for our next law at the library. You can find out more information about those online. And yeah, we'll see you next time. Thank you.
Great. Thanks, Mark.